Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories within company filings. Today we are diving into a very specific type of deal, a convertible senior note offering. And let me tell you, there is some juicy financial engineering going on here. This is a Form 8K filing, which basically means the company is reporting a material event that shareholders need to know about right away. In this case, it is all about CenterPoint Energy Incorporated and a big money move they just made. So what exactly did CenterPoint Energy do? Well, they just sold a whole bunch of what they call convertible senior notes. Think of these like a loan, but with a twist. The company is borrowing a lot of money, initially $650 million, and they promise to pay interest on it. But here is the kicker, these notes can be turned into shares of the company's stock later on. This whole deal was done through a private offering, meaning it wasn't available to just anyone. They sold it to initial purchasers who then resold it to qualified institutional buyers. This is pretty standard for these kinds of deals. The net proceeds from this sale were about $641.5 million after all the fees and expenses. That is a lot of cash. The actual agreement outlining all the terms of these notes, the indenture was signed on February 26, 2026. The notes mature on May 15, 2029. That is about 3 years from now. The annual interest rate on these notes is 2.875%, which is pretty low considering the current economic climate. They'll be paying interest twice a year. Now, about that convertible part. Before a certain date, buyers can only convert these notes into stock if specific things happen. But after February 15th, 2029, they can convert them anytime they want, no strings attached. The company can't call these notes back early, and there is no special fund to pay them off over time. It is all on the maturity date unless converted. This is where it gets interesting. When a bondholder decides to convert their notes into stock, the company has options. They can give the bondholder cash for the principal amount, and then a mix of cash and stock for anything extra. The initial conversion rate is set at 18.6524 shares for every $1,000 of notes. This means the initial stock price they're looking at is around $53.61 per S-share. This is about a 25% premium over the stock price on February 23rd, 2026. That means they are betting the stock price will go up. If all the notes are converted at the maximum possible rate, that is over 15 million shares of common stock that could be issued. This could potentially dilute the ownership of existing shareholders if the stock price doesn't rise significantly. And there is more. If the company goes through certain big changes, or a fundamental change as they call it, the conversion rate can be increased. Also, if a special type of fundamental change happens, the company might have to buy back the notes at full price plus interest, or increase the number of shares given upon conversion. This is like a protection for the investors in case the company's situation changes dramatically. Like any loan, these notes have conditions and things that can go wrong. If the company fails to pay interest or principal, or breaches other agreements, or faces bankruptcy, these notes could be declared immediately due and payable. This is standard stuff, but it highlights the financial obligations the company is taking on. These notes are senior unsecured obligations. This means they are high priority for repayment, but they aren't backed by any specific assets. They rank higher than any debt that is specifically made to be lower priority than these notes. They are equal to other unsecured debt like their other convertible notes, but lower in priority than any debt that is secured by company assets. Plus, they are structurally junior to any debt or liabilities of their subsidiaries. This is important for understanding how deeply indebted the company is and who gets paid first if things go south. This section just confirms that this issuance of notes creates a direct financial obligation for CenterPoint Energy. It is essentially a loan that will show up on their balance sheet. This part tells us that these securities, meaning the notes, were sold without being officially registered with the Securities and Exchange Commission. This is allowed because they were sold to sophisticated investors, like qualified institutional buyers, and reliance was placed on certain exemptions from registration rules. And finally, here is the list of official documents connected to this deal. You've got the indenture itself and the form of the notes. These are the full legal documents detailing every single aspect of this convertible note offering. So let's break down what this all means for CenterPoint Energy. They managed to raise a significant amount of capital at a relatively low interest rate, a clear positive. The convertible feature allows them to potentially reduce their debt if the stock price performs well in the future, which is a smart way to manage their balance sheet. However, the threat of dilution is real. If the stock price doesn't climb enough to make conversion attractive, the company will have to repay the $650 million plus interest in 2029. A key risk here is what happens in the broader energy market and how investors perceive CenterPoint Energy's strategic direction. If the company faces unexpected challenges, or its stock price stagnates or falls, the convertible nature of these notes becomes less of an advantage and more of a guaranteed repayment obligation. Looking at the broader context, CenterPoint Energy is a major player in the energy infrastructure space. They are involved in electricity transmission and distribution and natural gas distribution. Companies in this sector often use debt financing to fund large capital projects. The low interest rate on these notes suggests that lenders have confidence in CenterPoint's ability to manage its obligations. My take on this is that it is a calculated move by CenterPoint Energy. They're trying to build flexibility into their capital structure. The company is betting on itself and its future performance. If they execute their strategy well, this convertible note issuance could be a win-win. Investors get a decent yield and the company potentially strengthens its equity base without immediate dilution. The main question remains, will the stock price rise sufficiently to make conversion the preferred outcome for the note holders? Alright, that is our breakdown of CenterPoint Energy's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.